Okay, so the market feels like it's in a total free fall, right? And when that happens, every single one of us is asking the same big questions. How do you find a real bargain in all this chaos? And maybe even more important, how do you dodge those nasty value traps that can just wreck your portfolio? Well, today we're going to break it all down.
I mean, you just have to look at your screen. The signs are literally everywhere. The Dow has taken a nosedive. The S&P 500 just wrapped up its worst month since March. And that classic fear gauge on Wall Street, the VIX, yeah, it's popped back up over 20. When you're staring at a screen that's just a sea of red, it is so tempting to think, hey, everything's on sale. And all that it forces the question, doesn't it? You know the one, is this the dip I should be buying? It sounds like such a simple question, but oh man, the answer is anything but. You know that little voice in your head, that powerful gut feeling that sees a huge price drop and just screams bargain? Well, Wall Street has a name for that. They call it the falling knife trap. And really, just understanding that impulse, that's your first line of defense against making a really, really costly mistake. So, what are we talking about here? It's when you jump in and buy a stock that's gotten hammered, down 30, 50, maybe even 80%, just because it feels cheap. But here's the thing you have to remember. The market isn't stupid. It usually cuts prices for a very good reason, and something that looks like a bargain can turn out to be incredibly expensive if the actual company underneath it all is falling apart. And the psychology here is just fascinating, right? It's all thanks to a little trick our brains play on us called anchoring bias. Basically, your mind gets latched onto a past price. Let's say a stock was trading at $100. So when it plummets to $40, your brain doesn't scream danger, it sees a 60% off sign. But here's the kicker. A cheaper price tag does not mean it's a safer bet. In fact, a lot of the time, it means the complete opposite. Okay, so this really brings us to the million-dollar question for any investor. How in the world do you tell the difference between a real bargain, a fantastic company that's just on a temporary sale, and a value trap, which is basically a business that's circling the drain? And believe me, the difference is night and day. On one hand, you have the true bargain. This is a solid business, just hitting a bit of a speed bump. It's still got a strong balance sheet, a real edge over its competition, but on the other hand, you've got the value trap. This is a business that's fundamentally breaking down. The cash flow is drying up, debt is starting to climb, and you can just tell its best days are way behind it. So if there's one thing to really drill into your head, it's this. You have got to learn to ignore that big, flashy 50% off sign. Instead, you need to look under the hood at the engine of the business. Are the fundamentals, we're talking balance sheets, cash flow, are they still solid? Because that right there is 1,000 times more important than how much the stock price has fallen. All right, that's the theory. But how do we actually put this stuff into practice? Let's get right into a simple, actionable checklist. Something you can actually use to help you steer clear of these traps and, just make smarter decisions. First up, check for business stability. You want to see steady revenue, real cash coming in the door. Simple as that. Number 2, look hard at the debt. Piles of debt can turn a little downturn into a full-blown crisis for a company. Third, you got to demand a margin of safety. That just means being super conservative with your numbers. Then fourth, and this one's huge, before you even think about buying more to average down, just pause. Ask yourself, okay, what's different now? What did I get wrong? And last but not least, diversify. Please diversify. No single turnaround story, no matter how good it sounds, should be big enough to sink your entire ship. So, to tie all this together, who is the master of avoiding these kinds of traps? Well, we have to talk about Warren Buffett, right? His entire philosophy, his whole career, is basically a masterclass in sidestepping falling knives. And his secret? It's really not that complicated. He just focuses on durable, sometimes boring businesses that he actually understands. Companies that generate cash no matter what the economy is doing. But his real superpower, the thing that sets him apart, it's just his insane level of patience. And there's this great saying that just perfectly sums up his whole approach. Think about it. Trying to guess the absolute bottom of a stock's fall is, well, it's pretty much impossible. So instead, he just waits. He lets the knife fall, lets the chaos die down, waits for things to get stable again, and then he takes a look. In other words, he waits to pick the knife up right off the ground. So really, the final question I want to leave you with isn't about how smart you are or how good your spreadsheet skills are. It's about your temperament. When the market is screaming, just absolutely yelling at you to do something, anything, Do you have the discipline to just stand there and wait for the right moment? Are you ready to let that knife hit the ground first?